Bum. Good morning, folks. Welcome to the Street Today. Welcome to the Street Today, here from Post 35 on the floor of the New York Stock Exchange. Today is Wednesday, the 18th of January. I'm fine. I'm your host, JD Durkin. We are about an hour or so into the trading session. Stocks are trading in the green. At least that's the case for the S&P. What's up with the Dow? The Dow is down fractionally right now after fresh inflation data showed signs of maybe inflation peaking. Producer prices slumped 0.5% in December, compared to the Street's analyst expectations of 0.1%. Of course, we got that all-important PPI figure out this morning. Investors a bit hopeful that the Fed will begin to ease rate hikes as prices continue to trend lower. Trend lower is the key phrase there. Let's take a look for what is on tap for this morning's broadcast on this Wednesday. It's also, for whatever it's worth, National Thesaurus Day. That's true. I don't think it matters very much. Anyway, on the show today, we'll be digging into the latest on the earnings front as corporate earnings season rolls on. Plus, we'll break down fresh retail data as consumers start to pull back on spending, especially during the all-important holiday shopping season. So we're going to get Martin's perspective on that in just a bit. And finally, we'll tell you what is going on with Moderna as the drug maker receives positive news from its RSV trial. For more on those stories and so much more, we now bring in our chief markets correspondent, Mr. Martin Bakkerdax. Mr. Bakkerdax, good morning to you here, my friend. So markets closing mostly lower on Tuesday. It was an interesting session where the Dow was uniquely being hammered by the numbers we saw out of Goldman. But overall, give me your sense about what is weighing on investor sentiment, either between the close of yesterday into 62 minutes into the start of today's session.
Gosh, I mean, so much has happened in that time, JD, which is really quite amazing, because if you'd asked me this question at the end of trading yesterday, I would have said that we have only just kicked off the earnings season and we don't have the clarity that maybe investors were looking for when they parsed through the numbers that we saw from the investment banks and indeed the commercial banks and the small number of companies that have reported so far. Essentially, we had an outlook for economic growth that was as anticipated from the banks. And numerically, we are right on target in terms of where we expected to stand in terms of earnings beats, in terms of the likely decline in overall S&P 500 profits for the 3 months ending in December. So we're no further along in understanding, and I think that was in large part reflected in the indecision that we saw in trading yesterday. Now, coming into this morning, we have a different picture altogether. And that, of course, is as a result of this slump in retail sales, the producer price inflation data, which you referenced, and the fact that we are now seeing potentially accelerated bets on a near-term recession, both globally and here in the United States. So even with the tame inflation numbers, you're not getting the corresponding boost in stock prices, because my sense is that investors are waiting for that missing clarity on earnings. They likely won't get it in the coming sessions. The bulk of the best numbers are going to come next week and the week after in the tech sector and the consumer sector. And as a result, there might be a little bit of flatness, I guess you could describe it, in markets until we get there. But right now, we're holding on to modest gains. I'm modestly surprised that we're actually holding on to them, because we have booked a reasonably solid rally so far this year. But nonetheless, the momentum is largely positive. The S&P 500 is holding on to that 4,000 point level, which is pretty much at its 200-day moving average. It's a very technical data point that traders will focus upon, and investors should pay attention to as well. So all that in the mix gives us these positive gains, but so much has changed in that 24-hour period that you just described.
And since every conversation invariably involves the work of the central bank in one degree or another, I will just bring out a little bit of breaking news here. You certainly don't need to respond to it. But according to the Fed Chair Jay Powell has tested positive for COVID-19. That according to an announcement from the central bank here just the last few moments ago. They say that Powell is experiencing, quote, mild symptoms, and go on to say in a news release that Chair Powell is up to date with COVID-19 vaccines and boosters. Following CDC guidance, Powell is working remotely while isolating at home. and no further details there were provided. Again, that's just breaking here in the last moment or so. We don't know exactly what impact, if any, that will have on the upcoming FOMC meeting. Of course, still a couple of weeks away, but since we are live here, we figured we would just bring that live report as we get it. That's the reality for the world that we're in here now. I do want to get your perspective. First, is there anything on that? I mean, listen, we've covered this through the lens of politics for presidents who have gotten COVID-19, and the running joke by many is the most important person in the world at a time like this might not be the president, actually might be the chairman of the Federal Reserve. But it seems as if no indication, I think he won't still be able to still do the job, even if he's stuck at home in quarantine for a while.
Yeah. Well, I mean, first and foremost, JD, I'm sure you'll agree with me that we wish Mr. Powell all the best and hope his symptoms are indeed mild. And we, wish him a very quick recovery. I can tell you through personal experience that I tested positive for the first time just prior to Christmas. Was knocked out for a couple of days, but was able to recover reasonably swiftly and was boosted and vaccinated to much the same degree as Mr. Powell is. What's interesting to me in all of that, JD, is the way that the market reacts to these stories and how different it is, and probably rightly so. Even during the tail end of the pandemic, we aren't seeing a swift market reaction that we ordinarily would get as a result of a headline that's associated with the Fed chairman. And I think that does, to some degree, describe the changing nature of the pandemic here in the United States, which is really now morphed into an epidemic. In other words, not to get too pointy-headed about it, but with a pandemic, epidemiologists aren't able to predict what is going to happen as a result of the spread of the virus. It's just too chaotic. With an epidemic, it's the sort of thing that happens with a frequency that makes it more predictable. And that is sort of where we are right now. Even though we are seeing an acceleration in infections through the new variant, it's a bit more predictable and a bit more trackable than it would be in a pandemic. And that change in nature is a big part of the reason why we're not seeing the market reaction that we might ordinarily get.
Yeah, absolutely. No, that's great. And I appreciate a bit of context there, even on breaking news that neither of us were expecting to have to cover here as this show started. But since we are live, these are the sorts of things that we can do to at least keep viewers up to date with anything that may or may not move markets. One thing that is certainly top of mind, and I know you had been following, I do want to quickly shift our attention overseas, Martin, talk about, I wonder if it's considered a unique approach from the Bank of Japan, keeping rates low despite high inflation. I believe we have a quote here. This is from the quarterly outlook report from the BOJ. They say that Japan's economy, despite being affected by factors like high commodity prices, has picked up as the resumption of economic activity has progressed, while public health has been protected from what we were just talking about there, COVID-19. Is their calculus seemingly so different from a lot of other major banks, either what we've seen overseas or what we've seen here in the U.S. with regards to rates versus inflation?
Yes, I think absolutely, JD. Japan has, at least for me, always been the poster child against the argument that inflation is always and everywhere a monetary phenomena. This is something that economists absorb with their baby food. It was expressed by Milton Friedman in the late 1960s and essentially has been the plank from which interest rate decisions and monetary policy has been built. Now, I think it's been torn completely to shreds as a result of the economic situation in Japan, an aging population, an island nation that isn't particularly welcome to foreign visitors or indeed foreign workers. They have been printing money through quantitative easing largely since the mid-1990s, and they haven't had a whiff of inflation until the COVID pandemic, when supply chains were disrupted and prices went through the roof. Now, we're going to get data from Japan on Friday, in point of fact, JD, that probably will show headline inflation at the highest levels in 41 years. But the Bank of Japan seems a lot more confident in the idea that it's going to pull back very swiftly, and as a result, they didn't see the pressing need to make any significant changes to its monetary policy. Now, that may prove to be a mistake, but what it does, at least for me, is define the fact that Japan's economy is standalone different with regards to these inflationary pressures because of the demographic situation and because of the nature of its export economy. Now, it did catch markets off guard, it has to be said, because there was a full anticipation that the BOJ might tighten a bit ahead of these data that we're going to get on Friday. There's a subtext in this. The Bank of Japan governor is going to retire in April. A new boss is going to come in. Japan's fiscal year ends in April, which is a little bit different than many other countries. So as a result, the assumption is that the current head of the Bank of Japan might wait for the new boss in order to really put in measures that are different from the current ones, but we don't know that for sure. What we do seem to understand is that they are confident that inflation is going to pull back. We curiously had similar rhetoric from a member of the European Central Bank during the World Economic Forum in Davos this morning, saying that the peak rate might not be as high as anticipated because of these easing inflation pressures. And then, of course, we had the PPI data here in the United States. So inflation is turning that corner. And that is why you're seeing that big rally in bond markets overnight. 10-year note yields here in the United States have tumbled about 12 to 13 basis points in less than half a session. That's a really big move. Some of the biggest moves in decades in Japanese government bonds overnight as well as a result of that BOJ decision. But all of it is more sort of rolled in, JD, to this idea that whilst inflation was absolutely and completely the story over the last 18 months, that is going to fade very, very quickly. And as a result, investors are going to be focused upon many other things apart from central banks. And quite frankly, I think that's the way the central banks would prefer it.
Forgive me, Martin, who at Davos had such bullish hope for the future with regards to an easing of rate hikes? I just missed the individual.
Yeah, no, it was the governor of the Bank of France, actually, who is one of the members of the European Central Bank, which puts together monetary policy decisions. Essentially, the executive, not the executive board, but the governing council is comprised of the central bank governors from all of the member states that share the euro. So he made these comments during Davos this morning.
Okay, thank you for that. Yes, and obviously one of the stories that we've been covering here is to what degree either the market is not on the same page as the Fed, and some people say, well, we know what the Fed has said, but we still think they're going to do something different, which is just going to be a fascinating story to watch itself play out. And of course, as we mentioned earlier, the Fed is set to meet officially here for the first time in just a couple of weeks, early February or so, shortly before President's Day. I do want to ask you about bonds, because we've gotten cooler inflation data. Treasury yields have dropped. However, we did have the worst year on record for bonds. So what is the state of the bond market as we're now a couple of weeks into officially kicking off the new year, Martin?
It's been on a significant tear since the latter part of last year and into the start of January, largely as a result of these changes in inflation outlook. Inflation is the enemy of bonds, JD. If you are a fixed income investor and you are taking coupon payments sort of every 6 months, the value of those future payments is going to be eroded by faster inflation. And therefore, bond prices fall to compensate. So what you're seeing now is bond prices rising and yields falling as a result of this changing nature of inflation. In other words, the erosion that you thought you were going to get is not going to happen, and you have to adjust prices as a result. So we're seeing big declines in bond yields as prices rise, and we've been seeing that now for the past 4 or 5 weeks. That has happened in concert with big changes in the expectation for Fed rate hikes. The assumption now, according to the CME Group's Fed Watch, is we're looking at a 93% chance of just a 25 basis point rate hike on February the 1st when the 2-day meeting wraps up. We're probably only going to get one other 25 basis point rate hike by the springtime, and then bets suggest that the Fed will hold, and of course now there's accelerating bets on even a rate cut in the second half of the year. All of this is being reflected in the bond market and the US dollar, where it tends to reflect first, it has to be said. So it's a big change in bond dynamics, and a big reason why, JD, a lot of major investors are talking about the need for people to alter their portfolios to have a heavier fixed income weight than they are weighted in equities, to sort of adjust for the fact that we're seeing these slowing inflation dynamics, and that corporate profitability is likely to contract as a result of the possible recession, or at the very best, the weakening economic session.
Yeah, absolutely. Well, stocks are inherently riskier instruments.
Yes.
Add to the fact that it's expected to be a volatile year. Now, for all the people who had said, okay, well, your kind of final level for the S&P might be 4,000 or so, it is, as we currently speak,
4,000.
3,989. Yeah, it's
Yeah.
just under, as we've seen a little bit of red. It has fallen into negative territory in just the last 10 minutes or so that we've been speaking. I do want to ask you about retail sales, if I may here, my friend, falling 1.1% in December from the previous month. That's the biggest monthly decline in all of 2022. Martin, it was also the second consecutive monthly decline. Yeah. Some people may sit there and say, well, wait a minute, you're talking about November and December are the months of decline. This is the heart of the holiday shopping season. What happened here? So does this tell you that we're actually slowly trending in the right direction? And was this kind of expected, given the fact that despite all of the spending, people were likely going to continue to want to spend because it was the holidays and the vibes were such where people wanted to spend more?
Yeah, that's the difficult part of this retail sales number as it is reported each month, JD, is that we can't pull as much we can't pull as many clues out of it as we would like. It's a nominal figure that isn't adjusted for inflation. So essentially, it's just a complete tally of all the goods that are sold, mostly goods that are sold over a particular month, including gasoline. So as a result of the big decline in gasoline prices over the month of December, that headline number is going to fall, and as a result, the percentage decrease is going to expand. So you see the slump of about 1.1%, but in large part, that reflects not only gasoline price declines, but auto sales and a bunch of other things. Now, one of the most important numbers in all of this is what they call the control group, which strips away a bunch of things: gasoline, building supplies, car sales, mobile home sales, and a bunch of other things. That distilled down number is meant to give us a better understanding of spending patterns, and it is then fed into GDP calculations and into the PCE inflation calculation that the Federal Reserve relies upon. That control group declined 0.7%. That was more than anticipated, and probably gives us a better reflection than the headline number. I think some of the assumption, JD, is that deep discounting in October and November by a lot of retailers, and we talked about that, companies like Target, Walmart, Home Depot, and others bringing forward their holiday sales into October, meant that October and November sales were reasonably resilient, whilst December retail sales, as you can see, weren't particularly solid. It reflects the bringing forward of those sales. It reflects the discounting that was on offer in December, and therefore lowering the nominal sales value. And probably thirdly, and potentially even most importantly, it reflects the fact that consumers are just paring back on discretionary spending. Inflation is still sticky, particularly at the consumer end. We're not talking about core, we're talking about real world inflation. That's still really high in historic terms. And there's indecision in the job market, and people will pare their spending habits as a result of their perceived risk for their employment situation. So that's really the mosaic, if you will, from the numbers. But the headline doesn't tell that story. It really does bear digging into to get some full understanding. And even then, it's a bit more of an art rather than a science.
I mean, my policy at this point of the show is that anytime that you use the word mosaic or tapestry, it's 10 points automatically on the board. So
I like it.
A mosaic reference there will always earn you 10 points. So thank you for that. A lot of names will continue.
30 points?
What? Say it again?
Am I past 30 points?
Oh, yeah, of course, absolutely. Like unlimited points, however many points you want. Mark, we do have a lot of big names reporting earnings today, and as the week continues to roll along, would you be so kind as to remind us of some of the big ones that we are watching?
Reported or coming up, JD? In terms of reported, United Airlines.
Coming up. Yeah.
Coming up. Procter & Gamble tomorrow morning. I think that's going to be important. United Airlines as well. American Airlines as well. And then after the bell on Thursday, we'll get numbers from Netflix, and that'll be, of course, fascinating to watch. And then we get into the tech earnings next week, Tesla included. So there's a lot to play for in the coming days.
Absolutely. Okay, so now let's look in the rear view. Let's talk United, because who doesn't want to travel right now? I mean, my goodness, look at these numbers. Look at their forecasting for the year. Recession, no recession, pull back on retail spending. It doesn't. People want to fly, Martin. What are we talking about here?
Really good numbers that they're being displayed just there. I mean, beating the street significantly on the adjusted bottom line, and even ahead on revenues as well. And this revenue tally is above 19 levels, which is impressive on its own, because of course we've had so many changes in travel situations in that period. Now, actually, United doubled down on that in the sense that they see the travel boom escalating well into 2023, and as a result, they see full-year earnings in the region of $10 to $12 a share. That's almost double the expected Street forecast. They say revenue growth is going to be in the high teens. They didn't quantify it specifically, but nonetheless, that's impressive. And they see their operating margins rising as well. They have a target out there of about 9.1% on an annualized basis. They were well ahead of it in Q4, and they say they're going to meet and beat it this year as well. But what they aren't talking about is capacity increases, JD. And I think from a passenger point of view, this might be the most important dynamic. Delta last week talked about how its costs are going to increase as a result of a deal that it struck with pilots. But keeping people staffed, keeping airlines staffed is not an inexpensive proposition, that it is going to pressure earnings as a result, even if they are going to rise to these impressive levels. So that probably means that capacity expansion isn't on the cards, at least in the near term. And unfortunately, even though TSA data shows us traveling at significantly higher levels than this time last year, and indeed higher than the 2019 peaks, there aren't likely to be more planes on the tarmac for us to sit in. So expect a crowded experience to get where you need to go.
Absolutely, about 7% or so of S&P companies have already reported, and of those 70% or so have beaten expectations. Is there the overall expectations of that trend continuing? Can keep the good times rolling, Martin? What do we think?
Probably not, JD. I think, well, it will depend on whether we hit that expectation level or not. And the expectation is that fourth quarter earnings are going to decline 2.2% from last year. Strip away the energy sector, they're going to decline 6.6%. So that's sort of where the line in the sand is. If we come in underneath that, I think the markets will see it as modestly positive. But what they may be looking forward to, rather than the beat for the fourth quarter, is what companies are saying about the near term. And we just don't have a large enough sample size as yet to really give us any great sort of optimism as to how we're going to drive forward. What the banks told us was largely anticipated, with the central case for a relatively mild near-term U.S. recession and a back half recovery. But the detail wasn't enough really to change expectations, or at least I didn't see it in market performance or in any of the analyst reports that I read. So we'll probably have to climb through this week and into next before we fully understand the quality of the earnings season and what the near-term outlooks are going to be.
Before we move on here and talk about Moderna, I do want to get your take on, we've talked about layoffs a lot, but yeah. You and I were also talking before the show about trying to bring a little bit of a big picture perspective to these headlines that we see. Microsoft, the latest here, revealing expected right-sizing, call it what you will, layoffs of about 10,000 or so employees. Satya Nadella said the job cuts, Martin, will represent less than 5% of the overall workforce. That workforce numbered north of 221,000 people globally as of the summer of 2022. What are we to make of numbers like this? Also keeping in mind the perspective that a lot of these companies, Amazon and many others, also went on a historic hiring spree in early 2020 and throughout 2021. And we have to kind of keep those numbers in terms of context in mind, even as we see the unfortunate reality of cost-cutting measures week to week today.
Yeah, for sure. I'm just going through it in my head right now, JD, and the way I sort of see it is that if you look at the three major job cut announcements that we've experienced over the last few months, you've had Meta Platforms, you've had Amazon, and now you have Microsoft. We might even add Goldman Sachs in there, but let's take the three sort of tech-focused companies. With Meta, you could argue that there are twin reasons for the job cuts. The first is that the advertising space is simply going into a significant slowdown into 2023. Ad revenue is going to decline sharply, and as a result, cost-cutting measures are needed there. And of course, Meta is taking on water and billions in red ink from the investments it's making into its sort of metaverse and virtual reality and all the rest of it. With Amazon, The job cuts seem to be more related to the fact that consumer spending is slowing down, and as a result, the consumer activity on the main portion of the earnings ledger, and that's the retail space for Amazon, is going to slow as well. So cost cutting and right sizing is needed there indeed. Now, with Microsoft, these job cuts seem to reflect, at least from the initial reading that I'm seeing, a sense that companies are going to pull back on investment spending. Microsoft sits kind of at the hub, if you will, of business investment optimism. When companies want to expand, when they want to add seats in their offices and to their business components, they're going to need Office 365. They're going to need software. They're going to need expansion of their cloud services, all of which comes from Microsoft. If companies are going to pull back on spending as a result of what they see as lower potential earnings, compressed profit margins, and uncertain economic situations, as a result, they're not going to hire, and indeed they're going to fire. And that is reflected, at least from my point of view, again, at this very early blush from what we're seeing from Microsoft. So of the 3 headline job cut announcements that we've experienced, Microsoft, I think, JD, is probably the most serious in terms of its market implications, simply because its tentacles run so deeply through S&P 500 companies, but also through companies all around the world.
All right, I do want to ask you about Moderna here and a bit of news there before we move on to our rapid fire section here. Martin, Moderna unveiled positive data from its RSV trial. What do we know?
This is really interesting. RSV is one of the most common viruses that is accelerating through the United States now. And in the sense, JD, that we talked about it in relation to pandemic versus epidemic, this is one that has sort of emerged now as one of the most significant contributors to deaths that are non-COVID related, but are experienced by very young children or older Americans with pre-existing conditions. There is no vaccine for it as yet, but what Moderna is trying to do is leverage its messenger RNA techniques and platforms to create a vaccine that would inoculate people against this expanding virus. And the late stage trial data that they published last night said that they actually had an very near to 84% effectiveness rate against 2 of the symptoms in older patients. And that's really, really good news, and a certainly very positive development on a virus that has the potential to kill, unfortunately, quite a few people in a bad flu season. So as a result, they say they are going to look for FDA approval likely in the first half of this year. It may not come online until maybe 2025 or beyond. But the early anticipation is it could be a big revenue boost for Moderna, which is looking to offset slowing sales of its Spikevax, the COVID vaccine. But again, more importantly, on a human sort of element, it's an important development for a vaccine against a virus that at present doesn't really have any protection.
Any idea this could potentially offset the drug makers slowing vaccine sales, to the point of something you were mentioning there a moment ago, but people will certainly wonder about the sales component about this, if it's impacted at all.
Yeah, I mean, ultimately it will be, but probably not in the near term. The numbers that I'm reading suggest we're looking at maybe 2.5 billion in sales from 2026 going forward. But that would be based on an assumption that it is approved for use for younger children as well as older adults. And again, that probably requires a certain market penetration as well. So those are early suggestions, but nonetheless, it'll be a welcome development for Moderna. It's interesting too, that company's mRNA, sort of messenger RNA platform has the potential to develop a lot of interesting drugs and treatments that we just aren't aware of yet. So it's always welcome news to see these companies leveraging a technique that delivered a really important vaccine at a critical time for the world. And now they're trying to expand its growth into treating other viruses and other diseases. And that's exactly, I guess you could say, how a capitalist system is supposed to develop and help people more broadly. Because of the investments that they put in over a number of years.
Absolutely. Okay, time now for our rapid fire section. First up, let's talk Albertsons. What's causing shares of the grocery store giant to pop?
We had a pop this morning. It's flattened a little bit, but ultimately there was a decision last night in the Supreme Court of the state of Washington that allows Albertsons to pay a special dividend. Now, Albertsons is in the middle of potentially being taken over by Kroger. Now, they're the two biggest grocery chains in the country. If they combine, it'll be a $25 billion deal. It'll be the number one grocer in America with annual sales of about $220 billion. Now, tangentially, the FTC is looking into the deal. There's all sorts of potential that it might not go through because maybe it will be ruled as anti-competitive. But prior to the deal, Albertsons wanted to pay a $4 billion special dividend to its investors. Now, many people said that the only reason they have that cash available was because they had been price gouging throughout the year as a result of the surge in food inflation, and that they were actually taking that money to pay off some private equity investors. Now, the court didn't buy that argument, and they agreed to allow Albertsons to make the payment last night, and it's going to be made reasonably soon. So the $4 billion to shareholders is on the way. There's two significant private equity investors that are going to benefit from this, but other stockholders of record back in October are going to get a boost as well. So the stock got the pop as a result of that, but I think now maybe there's the assumption that the FTC and others will look more closely into the Kroger tie-up and therefore either delay the ultimate merger or maybe tear it apart altogether. We'll have to see.
All right, number two, let's talk FTX, reportedly hacked for $415 million. I mean, is it even possible for this whole thing to get even worse? What's going on?
It's really ugly at the moment. I mean, essentially those who are charged with managing the bankruptcy say that about $415 million is missing as a result of what they assume is hacked, what was illegal hacking, most of it in the international division and some of it here in the US division as well. Now, they say that they've recovered, I want to get these numbers right, about $1.7 billion in cash and another $3.5 billion in securities. But the value of those securities, JD, I think are completely ephemeral, and to quantify them at $3.5 billion, I think is fanciful at best and delusional at worst. There's no way that you're going to get $3.5 billion for whatever has been recovered, but that's another story. And then, of course, last night, Sam Bankman-Fried, the disgraced founder of the company, was forced to resign as a result of all of these fraud allegations, and indeed is facing 8 charges from federal prosecutors. Wrote in a Substack that actually none of this is true, and by his best guess, he'll be able to make U.S. customers of FTX whole. This doesn't appear to be based, JD, on any true understanding of the company's financial records because he doesn't have access to them. And yet he still finds himself out in the public space expressing his views. And I have to say, disappointingly, many of those views are picked up by mainstream media outlets all over the country, which really only further clouds our understanding of this situation.
Certainly. Okay, third and final, mortgage rate slide. Bit of a housing boost on the horizon. This is a difficult one to keep up with.
It is. This one might be really important, though. We had a reasonably big decline in 30-year mortgage rates, according to the Mortgage Bankers Association. They're down to 6.32%, and that's the lowest since September of last year. That itself isn't maybe necessarily the story, though, JD. We saw today that home builder sentiment is finally on the rise after essentially 12 consecutive months of negative readings. Now, the reading is still negative, but for the first time, it's a little bit less so than it was in the prior month. And housing starts and existing home data is on the way over the coming days. And we may be looking at a bottom of the housing market as a result of all the rollover data that we've seen over the past months. So if that can be matched with consistent declines in mortgage rates, there's an excellent chance that the housing market could start to look at some sort of either stabilization or recovery into the back half of the year. It's certainly going to start with mortgage costs. And if the inflation forecasts and the Fed betting is correct, those are going to be moving in the right direction as well. So this may prove to be the sort of trough, if you will, of the U.S. housing market, and it is going to be led, I think, by these lower mortgage rates.
All right on. The great Martin Bakkerdax, thank you for helping us get smarter together as we do every day. Looking forward to doing this again tomorrow, Martin. Thanks a lot, man.
Great. Thanks, JD.
You know, it's a great show when your head is spinning from all the important topics we were able to hit, but we did it together. Martin, thanks. All right, folks, that's going to do it for The Street today. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.